welcome to the M&A Zing, the show for acquisition entrepreneurs, search funders and holdco builders across the UK and Europe. We regularly dive into real-world stories and strategies and challenges behind buying and building SMBs. And whether you're just starting out or you have a wide portfolio of companies, this is your space to learn, share and inspire. And in the next in our series of interviews today, I'm joined by Sam Simpson. Sam is an exited founder, an angel investor, CEO of Founder Catalyst and co-founding COO of Forge Technologies, an ongoing buy and build platform of digital and cloud services businesses. Sam is frankly a modern day polymath. Qualified in quantum physics, most relentlessly hard-working leader I've met, and one of the nicest human beings I've had the privilege to know. He was also one of the first investors and operators I recall having ever met who had deep experience of both angel investing in venture opportunities and in growing equity in established companies through buyouts. So, Sam, it's an honour to have you with us, sir. Thanks for joining us today.
Great to be here. Thanks, Gareth.
So every founder faces challenges, but what would you say are the universal hurdles that entrepreneurs encounter regardless of the industry, and how have you personally navigated them in your career?
This was a lesson really in my first brush with entrepreneurship. You go in naively thinking everything will be great and you're not really sure what to focus on. And for me, it came down to 3 C's, which is a relentless focus on customer, a relentless focus on colleague, i.e. surrounding yourself by the right people, and a relentless focus on commercial as well. And yeah, all of those 3 lessons were hard learned. And there is a great saying in the startup world, which is first-time founders focus on product, second-time founders focus on distribution. And that is, if there's one takeaway from today, I would say learn that and make sure you relentlessly pursue that.
So how exactly did you learn that? Because your entry into entrepreneurship has an interesting origin story. Having worked previously in a fast growth PE-backed company which reached about 450 million in revenue.
Yeah.
And how did the ending of that story, that origin story, spark entrepreneurialism for you?
Yeah, and I guess I learned lots of those lessons subconsciously in that journey with a company called 2E2. So my first small foray into becoming an entrepreneur, I started a company called EvoTree, which was acqui-hired back in the day by a company called Prime Business Solutions, which was then acquired by 2E2. And 2E2 was a buy and build, PE back, loads of bank debt, as you would expect. And that grew from just a group board with 0 revenue to about 450 million revenue over 15 or 16 years. So it was one hell of a journey with about 14 or 15 acquisitions.
My goodness.
So it was really good fun until it wasn't. I guess I learnt the colleague thing there. I surrounded myself, or I was lucky to be surrounded by just some amazing people. And lots of those I still work with to this day.
And how did the 2E2 story end?
Very, very badly, as I've alluded to. So, in hindsight, it went very well for me, but at the time it didn't feel like it at all. So, typical story, buy and build, loads of bank debt. The bank debt, lots of it were loan notes, which were collected in, 2008 roughly, and were at 18% interest. So the company was profitable, 450 million revenue, about 10% EBIT. So you go, great, you're at 45 million EBIT a year, but that's earnings before interest, obviously. And the loan notes were, you were paying out 18%, and when you've got 300 million pounds worth of loan notes and bank debt and PE.
So all the cash you were making was going to the lenders?
Yeah, and more. And all of that unravelled. It was January 2013, I remember it very well. It was the end of January, 27th of January 2013. There was, I knew things were afoot anyway, but 700 people were called onto a conference call. This is pre-Zoom, thank God. 700 people on a conference call, all told, the company's in trouble, you're all being made redundant, there's no pay for January, no pay in lieu of notice, no redundancy pay, no expenses, no nothing.
Wow, basically. They ran it right to the wire.
Yeah, they ran it to the wire, ran out of cash. I think they were hoping that, the banks or somebody else would have chipped in. It was frankly unthinkable that a 450 million revenue business can disappear like that, but genuinely
were there some hefty assets in there?
No, there was nothing. It was was lots of people, they rented some data center, probably in the long-term contracts. were the biggest asset, but there was nothing tangible that you could. So yeah, it was carnage. The first day, 700 people out of 2,500 employees were let go.
Goodness.
The next day, another conference call with 700 odd people. I actually got to witness a administration process, liquidation process. I was actually the most senior person to survive the journey. Which is not a great accolade,
But
I'll be honest.
did that mean it landed on your shoulders, any of it?
I worked, I mean, it was interesting because I got to work with the liquidators, which was a fascinating process. It was eye-opening.
Seeing behind the veil?
Yeah, it was seeing how they can operate is genuinely terrifying. And it was, heart-wrenching. It was pretty much my first job. I joined them as the most junior engineer. I ended up as head of project services with 130 people working for me and about £230 million worth of run rate projects.
Wow.
So I'd kind of gone a really long journey. It was kind of the only thing I knew from a career perspective.
But had no foresight that those 150 people were for the off as a consequence of the mass redundancies. Like no privileged inside information about
not at all. I mean, you get to see some of the issues. Being kind of a member of senior management team, you get to see the issues, but it was unthinkable really that the business could collapse. And you would have expected that somebody, PE or whatever, would have tried doing break it into bits and sell the bits off in a structured. Absolutely not. They threw the keys in, walked away, and
my goodness,
and that was it.
Wow. Well, that was what 12, 13 years ago now, coming up, I suppose, was it?
Yeah, 12.
And how did that process or that end game change your worldview at that tender age that you were when you were in that situation?
Let's put it this way, I'm never going to rush and take bank debt into any of my businesses. And I have a very strong aversion to institutional cash as well. Probably an excessive fear of what that can do, having seen it firsthand. So at that point I made a promise to myself, always be my own boss, never take private equity cash, and do everything I can to avoid debt-based solutions as well, because I don't think they're a great fit for lots and lots of businesses, unless you can do invoice factoring, or you're rich in assets you can leverage and mortgage against.
Yeah, sure. Debt service cover ratio is vital, and if you are running it up against the wire, then yes, you probably already lost the battle, maybe, or at least made your life more difficult in the process.
Exactly.
So, coming out of that situation, we're obviously going to go on to talk about some of the more successful chapters of your career. But I think it might be worth touching on another life lesson learned along the way, because you've done a few acquisitions, and certainly in the early stages when you were cutting your teeth, you made what could be termed an ill-fated acquisition of an events-based company. I know I'm jumping around a little bit in your career time frame here, but just while we're talking about, adverse life experiences and lessons learned, how did that play out?
Yeah, that was, again, not a great lesson. I've got a few horror stories, and this is probably the most painful for me. So after I successfully, and we are jumping forward, but I successfully exited my business, was looking for something to do, and a bit of angel investing here and there. And one of my friends contacted me and said, there's an events business, it's about to go into administration, the landlord's looking for somebody to pick it up, is it worth a chat? And I'm like, yeah, of course. So I'd been kind of on the administrator's side, not on their side, but I kind of seen that side. So I'm like, how difficult can it be to play the game with administrators? And anyway, we put an offer in for this business, and it was amazing. I remember the day we took over, the whole event space that we owned was rented out to Microsoft, and they had Satya Nadella over doing so it was a really premium space. They were doing their European tech launch of an AI an AI thing. So it was really, really interesting, and they had lots of high profile customers and things like that, and it was all going well. You
could see the attraction of it if that's the clientele.
Exactly. And it was a big player as well and things like that. Anyway, so that was going really well until it didn't, until COVID happened. COVID happened, and the government obviously said, there were no events, you weren't even allowed to work in offices. So that pretty much mothballed the business.
And there's no aid, there was no financial assistance for that sort of asset?
There was some, but it couldn't save us from, unfortunately, the landlord. So when the restrictions were limited, the landlord said, well, great, we'll give you a let on the rent for the space over the period, but you owe us a service charge of £1 million. We were like, right, well, we can't have used the space. We couldn't have. So that was it. We threw the keys in at that point. So that was
goodness me.
It was just a matter of timing, and we won't be the only kind of events business to go bang during the COVID
Oh no,
times.
plenty of casualties. I think you're in good company.
Yeah.
But yeah, how could you have ever foresaw? How could any of us ever have foreseen those situations? Okay, so I didn't let it. You didn't let it stop you because obviously you've gone on to bigger and better things. But a precursor to that, from whence the capital to make those experiments came from, was obviously Rock, where you were part of the early team, part of the founding team, which had the happy ending. Talk us through the sort of the trajectory there, because it seemed to happen all very quickly. It was quite an accelerated trajectory, eventually exiting, I think, for an MBO to BGF.
Yep.
Right.
Yeah. So that was a fantastic journey. Frankly, 2E2 collapsed in a heap. Me and three of my colleagues from the 2E2 days went, well, this is all very unfortunate. Should we go and do something else? And then, set up Rock Technologies. We actually stepped into a shell business that already existed, which was useful, so we didn't have to worry about, creating a bank account, insurance, incorporating.
And how did you go about coming by that business? Where did the shell come under?
It was one of one of the other three already had a business which was incorporated, so we stepped into that.
Very good. So you could hit the ground running.
We could, and the best decision I've ever made in my life. We stepped into the business, and we did so via investing in our own business via SEIS. So me and the other
genius.
It's me and my three co-founders, we all put £20,000 in. At the point, it seemed like a really good deal because you get £10,000 back, and that's all useful.
And of course, no one owns 30% of the business.
Because four of us, we all own 25% each.
Lovely.
So we invested in the business under SEIS. Put 20 grand in, got 10 back. That was all very good, and then forgot about SEIS until later down the line, when all of a sudden it became
very important,
very very important. The business went really well. I think within our first 2 months we did $500,000 in revenue. Within the first year we did 4.8 million, and pretty much doubled up.
And where were you finding that business? Was there some some low-hanging fruit you could pick up from 2E2, or was it an entirely different proposition?
Yeah, that's a really good question. And we weren't just really great at selling and really lucky. What we did, we looked at colleagues from 2E2 and said, who do we really know and love there? Which people would we absolutely choose to have in our team moving forward? We picked up the phone to them, and there were two guys who were the only people in the UK who knew how to run a major supermarket's firewalls, for example. We picked up the phone to those guys and said, do you want to come and work for us? We'll give you exactly the same salary as 2E2. We won't miss a beat. We'll pay you from day one. Blah, blah, blah. And they were like, yeah, absolutely. So we went from the four of us to, I think, 30 employees within a month or so.
All bringing their book with them.
All bringing their book. And then, you had the opposite side of the conversation. You phoned up the major supermarket and went, right, so these two people now work for us. Do you want us to keep looking after your firewalls? And we'll do it on the same deal that 2E2 had. And they went, yes, please.
Beautiful.
And we went from, 0 employees to 30 employees in a month or two, which in some ways is great because they all drag the revenue. In other ways was terrifying.
What a sharp growth curve.
Having that
financing
level of
the
salary,
cash flow of that as well. Well, yeah, just the working capital requirement from a standing start is a tough one, right?
Exactly. So
your clients aren't going to pay you up front.
No, and supermarkets aren't known for putting their hands in their pocket.
Or for paying quickly.
Yeah. And so we started the business in literally February 2013, and the major supermarket I'm talked about paid their first invoice in November of that year.
Gosh.
And cash is king for a small business with the growth curve. Anyway, so we went, from, we did 5 million revenue in the first year, double. We picked up Sunday Times Tech Track, second fastest growing company in the UK, and Financial Times, 17th fastest growing company in Europe, which was perfect timing because we'd already had a conversation about a potential exit. Now, two of my co-founders wanted to do a buy and build strategy. Yeah. So they wanted to take PE cash, loads of bank debt, and go and hoover up some other businesses.
Of course, you've seen how debt had played out previously.
Yeah, if you remember what I said 10 minutes ago, my appetite for doing a buy and build was absolutely zero. We did the usual, appointing corporate finance, found ourselves a good lawyer, went through the process of doing a beauty parade and writing an IM and sending that around. And our timing was perfect. We were really hot property due to winning those awards.
And also, it was a real great moment for the Business Growth Fund (BGF) with Stephen Welton and the team, with the massive amount of pension funds and government money.
They
were allocating right to just this kind of strong, fast growth UK success story.
Yeah, and platform plays where you can bolt other businesses on, and
and happy to take minority positions as well.
Exactly.
Right? To be more mezzanine than anything. So is that the sort of deal that you ended up doing then? And part of that was to cash in a lot of your secondaries and leave these guys that wanted to play with the debt markets to it.
Yeah, that was exactly it. So of the 4 co-founders, 2 left, 2 stayed. An acquisition happened in parallel, which was required to meet the BGF terms. So there was an acquisition happened in parallel with 2 of us exiting, and that was a very good day. I remember.
I can imagine.
Yeah.
And played out well since.
Well, and to go back to why some people on the podcast listening to the podcast may not understand the importance of SEIS. So I put 20 grand in, I got 10 grand back. The other benefit I had was complete CGT exemption on exit.
Yeah.
So didn't pay a single. I haven't even touched my entrepreneurs relief or BADR as it is now.
Of course, because it's ring fenced outside of that. Yeah.
Exactly. Yeah. So I didn't pay a penny on tax on an exit. So the best decision I have ever made. And one thing that amazes me still, Gareth, there are so many people, specifically in the startup space, who could be making use of SEIS themselves as founders, and they're like, "Oh, it's too much hassle." And I'm like, paying 24% CGT on an exit, now that's hassle. Spending a couple of grand to get yourself SEIS on founder shares is...
Yeah. Oh, I mean, it should be elementary. It's absolutely table stakes, frankly. And with that, we'll come on to how one of your current businesses serves that market. But yeah, absolutely. If you haven't considered SEIS for your activities in terms of seeding your initial acquisition vehicle, tread carefully, because acquisitions could compromise it. But yes, there is definitely gold in them there heels.
Yes.
So you've exited Rock and you've gone on via one unfortunate incident with the events-based company, but you've gone on to effectively found one business and co-found another. In fact, you're co-founder of both businesses, right? Because you've got teams in either. So Founder Catalyst, give us a bit of an explanation of that. And while you're at it, your buy and build strategy that you have inadvertently found yourself in with Forge Technologies.
Yeah. Yeah. So, I kind of, when I exited Rock Technologies, I promised myself I'd never work in another IT company. I had spent all of my life in IT, and I'm like, I think I'm done with this now. I think there's lots of more fun things to do. Mm-hmm. And so I started angel investing, and over the last 8 years, I've got 33 investments. And I've got some real horror stories. I don't think we've got long enough to cover them all.
But I mean, similar portfolio and similar stories. So that's maybe for a different podcast.
It is. But anyway, yeah. So I started angel investing, and what amazed me, I kept going to loads of pitch events, bumping into really amazing founders who had great ideas, who just had no idea how to do a funding round. They didn't understand SEIS or advance assurance or term sheets. Didn't understand valuation or where to find investors. I'm like, this is bonkers. This is all elementary. So my original idea was to, write a bunch of content and give it away for free, and which we've done anyway. But then I realised actually there's a platform play here. There's a gap in the market to offer cost-effective services around everything I've mentioned, around helping founders navigate that journey, producing the funding round legals, managing the workflow between founders and investors, doing advance assurance and that kind of stuff. So I started Founder Catalyst with a very dear friend that I've known for decades. The lawyer who helped me set up Rock Technologies back in the day. We started Founder Catalyst 2, and that was for me scratching edges, doing something in a completely different area. And it's very humbling, actually, because it's my first step into a SaaS business, which is fundamentally different to anything I've done. Yes,
very different challenges, isn't it?
Yeah, it's been a really interesting learning curve, that's for sure.
And there seemed to be a degree of altruism about Founder Catalyst, which, it is a very commercially sensible business, but you didn't emulate others that were also building platforms for founder documentation at that time and go after percentage of the funds raised using the paperwork, which I thought was a really genuine thing to do in support of the founder ecosystem. ecosystem or the innovation economy, because there are a lot of founders out there getting fleeced for using this kind of boilerplate documentation and then being billed a percentage of the funds raised during using that documentation, which seems counterintuitive really for a company that needs all the capital it can get at the early stage of its existence. But you chose to go the fixed fee route and the all you can eat route, which I thought was really wonderful. Clearly the sort of decision you can only make if you don't have external shareholders to have to please, of course.
Yeah, and I guess there's two reasons for that. Like you say, the commercial model of some of the other providers just doesn't sit well with me. It feels predatory, and I don't like it. And secondly, I'm in that really, really lucky position where I don't need to earn any money, I don't need to make a living anymore, so I can do things with different motivation. And I guess thirdly, I needed a way to differentiate Founder Catalyst, and by offering hand-holding through the process by somebody who's been through the process, exited successfully, and is an angel investor, plus offering a very different commercial model, is a great way of differentiating the business for sure.
Yeah, and I think it's played out in the community you've built and the high net promoter score that Founder Catalyst achieves, and it's chalk and cheese in comparison to the other options. So really great to see how that's flourished. But I guess
I've just answered one of the questions you've given. So that was Rock Technology.
Oh, this is true. Yeah, that was Founder Catalyst. Well, let's get on to Forge.
Forge Technologies is my new IT company, and I said I would never open another IT company, but I had fear of missing out. One of my dear friends, Jeremy, we'd worked together in Prime Business Solutions, then 2E2. I'd poached him into Rock as our CTO, and he was still in there at this point. And he introduced me to a couple of his colleagues from a company, Ocean, and I poached Jeremy from there. So that was all a little awkward, but we got over that quickly. And the IT industry is incredibly incestuous, as you know.
Oh, yes.
Anyway, and the three of them were looking to start up an IT company and said, do you want to come along based upon your experience in 2E2 and Rock? And, there feels to be a gap in the team that you can fulfill. And I was like, absolutely, count me in. I had massive fear of missing out. And I'm really glad it would have been easy for me to spend all of my time on Founder Catalyst and miss out on the fun that is Forge Technology. So I'm really glad I did that. And we're absolutely not going the 2E2 route. We're not taking on any external debt. We're not, we're
so
not
that's interesting. So, but it has done some acquisitions, right? Forge has been acquiring some businesses quite avidly in recent months. I mean, it was formed in 2021.
Yep.
And how many acquisitions has it got under its belt now?
We've got a couple, but they're mainly acqui-hires. So they are, right. They are acqui-hires. They are people we know from the industry. The benefit of having worked in 2E2 and having 2,500 people exploding into the rest of the kind of IT ecosystem.
It's created a diaspora.
And lots of people that we know doing really interesting things. And the most recent acquisition I'll talk through was a company called Zora. I know Caleb and Stuart from 2007, 2008, something like that. Really amazing guys with totally different skill set to anybody else in Forge Technologies. And they made such a natural bolt-on to the existing services. Forge at that point was all infrastructure, it was networking and desktop and cloud, so that kind of the more lower level infrastructure, and these guys played business process re-engineering, all of the kind of Microsoft Power BI proper consultancy play. So
stuff that sits over the top of the infra.
Entirely complementary to what we did already, and it's created a lovely cross-sell, upsell opportunity. All of our existing customers where we're delighting with services in the infrastructure, they are very open to having conversations where we go, well, we think you can optimize this part of this application, or you could be doing this very differently, or why aren't you doing integration and automation here? They're very open to having those conversations because we've earned the right to sit at the top table and have those chats.
So it wasn't just about these guys bringing their book with them, it was also about being able to sell more services to your existing customers and increase your average revenue per customer, which is genius, Sam.
And also drive us up the food chain. The infrastructure stuff gets you so far, but these guys have a very different dimension and allow us to have a different conversation with the customer as well.
So how do you split your brain in two? Because these are two vibrant, fast-growing businesses in slightly different camps. I'd be interested if there's any synergies that you've discovered between the two.
Yeah.
But how do you have the discipline to sort of time box and make sure that you are giving attention to each where it needs it?
Yeah, I think I was somewhat naive and brave when I started both at pretty much the same time. Oh, and by the way, I had my daughter Sky, who, somewhere during the COVID period as well. Yeah. So, the timing was interesting. And I guess to come to synergies on time, let's cover that one first, because what I have absolutely done is tried to standardise wherever possible across the businesses. So, I'm responsible in both of them for back office functions and things like that. So
we've got a heavy degree of automation built out there?
Yeah, we got using the same automation in both. So we're using the same systems, the same automation, the same accountants,
Nice.
the same lawyers. We're using the same employment contracts. So the standardisation across it, because context switching to am I reading this paperwork or that, it would just be
really tough,
unwielding and horrible. So that's the first thing. The second thing, in both businesses we have incredible management teams, and that's probably a lesson in Rock Technologies. We, from day zero pretty much until the end, other than recruiting Jeremy as our CTO, it was the four of us that ran the business at the coalface, and we were integral to the business, which creates a scalability problem.
It's a hub and spoke problem, isn't it? It's a bottleneck
and a succession planning. If you're looking to exit, we got away with it in Rock. But
so you're the masters of delegation now, then?
I'm not quite there yet. I'm a control freak, which is a problem. But yeah, in both businesses, in Forge Technologies, we've got an amazing ops director who I've known for a dozen years. We've got an amazing sales director who took a competitor from, I think, 8 million to 100 million revenue. So we've got those. We've invested really, really early on in a management team that can, take us from 5 to 5 times at least the size we are.
5 times.
Yeah.
Marvellous.
Hopefully. Well, that's, fingers crossed.
Well, I was going to say, is that the ambition? Or
the plan in Rock Technologies was never to actually build for an exit. It was
this
to
is permanent ownership, is it?
Well, in Rock Technologies, that wasn't.
Rock,
that wasn't our plan. Was to build a business. So 2E2 had morphed into a business that none of us particularly liked and none of us enjoyed working.
Sure.
And I think that's by the nature of the way it was funded. Mm-hmm. Having loads of bank debt and banking covenants to worry about, it drives the business in a very particular way.
Who are you really working for? Yeah. And do you enjoy the work? It's a slippery slope, isn't it? But
so when we started Rock, actually, we're like, right, well, let's focus on building a business we're proud of, building a business our colleagues want to work with, and our customers, don't feel they're being chased for every penny. Because so we focused on that, and I think in Rock the exit was just opportunistic based upon some conversations we had, and also a diverging in desire. Part of the management team wanted to do a buy and build. The other part absolutely did not want to do that. So, that was going to come to a crunch at some point. Mm-hmm. I think, the motivation's the same in Forge. We want to build a business we are, we're delighted to work at every day. Us and our colleagues are delighted to work at, and our customers are delighted with the results. And I think if you wake up every day and try and do the right things, then good things will happen. So we're not on any fixed trajectory at all. Actually, in either of the business, I've got no, as I'm massively emotionally attached to Founder Catalyst. It's my baby. I can't imagine letting that go.
There's definitely a clear sense of mission there. There's definitely, I can see how it animates you whenever we talk about it, which is lovely to see. So, but both are permanent plays. Although recently in Founder Catalyst you've recruited some sort of senior management, and your control freakery has been relinquished a little, and you've let these guys flourish, these guys and girls flourish in the team.
A couple of key hires recently have been very, very good for my work-life balance. Let's put it that way. And even though it's my baby, I guess maybe it's a time thing, but I've spent the last 4 or 5 years in Founder Catalyst at the coalface, doing all customer calls, solving all customer problems, having every conversation.
Yep.
And actually, that's selfish of me, because I will end up constraining very, very soon our ability to grow. So I've got a new hire, Max, who's fundamental. He's head of sales, partnership, growth and marketing, who's just such a great hire.
Yeah, no, I certainly see that, and that's a real milestone, I think, for the business to have reached that point where it actually now starts to take on a bit more of a life beyond the original founding team.
Founder-led sales only go so far.
Well, it does. There's only so many times you could do a demo and feel authentic in doing it. Great. Okay. So, as I mentioned in the preamble, you're one of the few people that have got a foot in both venture and have had some buyout experience, right? And that I've met that has got clear opinions and clear perspectives on both camps. So, I'm really interested in what fundamental differences you have perceived in the sort of terms of risk profile and operational involvement and returns patterns between your angel investing and venture activities versus what Forge has been up to, or what has been happening in buy and builds that you've been involved with?
I mean, they're just fundamentally different asset classes, aren't they? It'd be like, it'd be like comparing running a business to gambling on the stock market or buying Bitcoin. And I'm not saying angel investing is like it is. In fact,
you might not say
that.
Who
am I kidding? I'm not saying that. I'm absolutely saying that. So angel investing is rolling the dice. It's putting money into business and hoping for the best. You have, unless you're very active in the business, which is really unusual, and certainly I'm not active across any of my portfolio other than supporting with funding rounds. You are putting money in and hoping for the best and trusting the management team. So there is a fundamental difference for me between those venture activities and the activities I'm involved day to day, and they're just fundamentally different.
And correlating, of course, with your percentage ownership, right? I mean, we take these bets on the angel investing portfolios, and we're satisfied that someone else has got it, and we're perhaps hoping for a 2-5% ownership threshold. Whereas it's much more material in the companies that you co-found or that you acquire, whereby that the slightest sort of 5% increment decrement on the EBITDA either way has kind of like personal impact. So
it does a massive impact. Yeah, and I'm never. You're never going to be able to retire off of an angel investment unless you get it radically right. Unless you're early stage in Uber or
you hit the or Revolut or
or anything like that. But so for me, that they are like any other investment I make. I'm hoping for a blended 3.5, 4, maybe more if I'm really, really good at betting. That's the kind of return I'm expecting.
But 3.5, 4 over a 5 to 7 year horizon isn't like great IRR, really, is it, in the grand scheme of things?
It's not, but then you fold in tax breaks and blah blah blah. So, and I'm not putting all of my money into angel investment. I've got
Thank God.
I've got kind of a broad portfolio. It's not all of my eggs in one basket. I am feeling bruised at the moment, so I can tell you one of my stories, just one.
Yeah.
As an angel investor, so. Very early stage in a business. I don't think it's in liquidation yet, so I won't mention them. No, it's imminent. So very early stage investor in a business. I think I've got £50,000 in there, so not a huge chunk, but
it's material. Though.
Not change. And
SEIS?
I think it was. I think it was.
So there's some mitigation.
Yeah, so there's downside. I'm risking 28% of that. However, I'd rather not have 28%. I'd rather. So they've done multiple funding rounds. They took a 15 million convertible loan note a little while ago, so their valuation's done really, really well. They were just about to close. I think it was classed as a Series B at just over 100 million valuation. So my 2 million valuation's gone to it. So I'm kind of 50 times my money, minus the dilution you'll get along the way.
Great, sounds good. What went wrong?
Everything. So they were just about to get I think it was 15 or 20 million investment. The founder was saying, keep an eye for your documents to be signed in the post, and brilliant, okay. And the next call was, the funding fell through, we're going into administration as of now. And it went from, yay, and there was talk of a secondary, you could have got out with 30 times your money or whatever. Now that's okay, on 50 grand, I'll take 30 times my money.
But the incoming investor found something they didn't like?
I have no knowledge at all. There's nothing been released. It was, CEO's been fired, the deal's collapsed, the company's going into liquidation. Now there is a rescue deal. People are talking to the administrator, but it's going to wipe out the existing cap table, so I get nothing.
No, that's a washout.
Yeah.
Oh, I'm so sorry to hear that, mate. That is bruising.
So let's not talk much more about venture right now.
No, quite. I had an interesting one recently, which was a portfolio company that effectively got vulture capitaled. They were in the ascendancy, they were doing all right, but there was an existential need for cash, and someone saw an opportunity to come in for sort of pence in the pound, and it was take that or go the way that your portco's just gone. So it's an interesting time, and certainly I think with the noose tightening and the capital, the liquidity not flowing into venture in the sort of the same abundance that it was 3 years ago, it's starting to play out in some unfortunate endings. So I guess my question is, if you had 10 million to allocate this year and you had a choice as to how to allocate it between or across or including, let's put property in there as well, because I know you've had some property in your portfolios, but angel investing early stage and acquisition of buyouts of SMBs, where would you put your money?
I would bet on myself. I think almost exclusively. So if I look at my time allocation rather than cash allocation, I spend all of my time working on my two businesses. To the extent, actually, yeah, you're right. I own half a dozen properties, but a mixture of commercial, buy-to-let, and furnished holiday let. And yeah, I just sold my last furnished holiday let very, very recently.
Yeah.
The tax treatment on that stuff is all going the
Well,
wrong way.
the second home piece is a big disincentive there, right?
Yeah. So and basically that's freeing myself up. I think. That's freeing my time up so I can focus on my two ventures and my young family and anything I can do to avoid distraction. So I will continue frankly continue to angel invest and use all of my tax relief is the answer. And I can't stop myself because when I'm working with Founder Catalyst, I see so many amazing founders and so many amazing businesses. Yeah. It's really hard to say no.
It must be very difficult, and I've had to cut myself off, frankly, awaiting returns. But very interesting. And that obviously it is a deal flow engine for you, Founder Catalyst, but that's not the primary reason. But I guess that's not going to be soaking up 10 million anytime soon.
No.
No. Good. So NS&I, here it comes then. God help us. Okay, so let's get on to sort of the current market and given your vantage point across these sort of multiple sectors, what emerging kind of trends or market shifts are you seeing that entrepreneurs maybe aren't paying enough attention to that perhaps they need to be keeping in mind?
I mean, the obvious couple of shifts over the last year are, an absolute dominance in AI. And it feels silly talking to you about it because you know this as well as I do, right? But there are so many founders out there who they've got a business, they're like, our business has nothing to do with AI, and they're ploughing on ahead. Every single business will be transformed one way or another by AI, whether it's integration with systems or customer outreach or automating process, whatever it is, every single business
it's going to proliferate.
Yeah, and if you're not taking advantage of it, your cost base is going to be much higher than those other businesses.
How many people, though, do you find are experimenting with AI in, say, customer services or something customer-facing that are finding themselves being talked out of doing so because it's just not the way that it's been done? Like, who's going to be bold enough to go and, make all of their CS or all their sales team avatars powered by HeyGen, for example? Is that really something we expect to be able to see happen? Am I going to look back in 12 months' time at this podcast and go, "Wow, what a fall of course"?
I think it depends very much on the business and the customer types and the importance of relationships. If you've got a customer who's spending 10 million quid, you're not going to let AI go anywhere near them. If you've got lots of low value, lots of customers but low value transactions, you'll be much more likely to let AI manage those relationships. And it's not necessarily about the interactions, it's everything else that's going on in the background. So I think automating, if you've got customer success team, don't necessarily automate that front part of the integration.
Everything after it.
Yeah, exactly. And also you can use AI to spot themes and write knowledge bank articles that are common problems. And then you have a real human to make sure they don't just look like they're being spat out of an LLM. But I think that's one of the fundamental shifts. And and like I say, you and I know that fundamentally, but so many founders aren't embracing it. I think that a fundamental shift in the venture space and probably every other aspect of the economy is 3 years ago, 4 years ago, it was growth at all costs, and now it's profit.
Of course, yeah.
It's a complete
Well,
focus.
it's tracked the macro, hasn't it? I mean, we've gone from growth stocks and the Magnificent Seven on the S&P 500, several of which were unprofitable, through to right now I want cash deliverable, cash generating, real assets. I want value stocks, and that's playing out in the private markets as well, frankly, and it makes the founder's job to get to profitability sooner, which it shouldn't become as a shock because that's how businesses were always run until the venture scene, right? But get to optionality on whether you need to borrow or sell equity or whatever, right? But run a fundamentally strong business that generates cash. Yeah. That's job one.
I think that was forgotten about for nowhere near a decade. I was going to say a decade, but probably 3 or 4 years in the height of the venture boom, everybody forgotten it was just customer acquisition.
Yeah, that was really toppy, and you look back now and what hubris the market had. Who did that really serve? The up and to the right confidence trick. Who did that really serve?
The third point I'd make, and sorry, I'll let you jump on to the next topic. The third point I'd make is, and what we're spotting a lot with our brands are, the companies that are doing well are at either ends of the market, i.e. they are at the you have no choice, or the luxury end of the market. The discretionary spend in the middle is the part we're seeing that are getting massive pressure because people can decide whether to do it or not.
I keep hearing about the barbell economy and like the squeezed middle.
Squeezed middle, exactly that. I mean, I'm very fortunate in Founder Catalyst that if you're a founder doing a funding round, you've got no choice. You need us, our competition, or a lawyer, and that's literally it.
Okay, so something we often lament in this market is the cost and complexity of raising commercial finance, right? But here we are, the interest rates are gradually coming down, lenders are starting to become a little more liberal. It's still more difficult to raise finance here than it is in some other geographies.
Yeah.
But for a UK sort of SMB, startup or scale up, debt is sometimes a necessary evil, but I'm interested, given your experience, what your advice tends to be about the risk versus reward of debt funding.
I think for lots of startups, debt just isn't an option.
True. Yep.
I think for later stage businesses, you've got invoice factoring, you've got asset-backed financing. There are lots of ways you can squeeze the debt sponge and get some money out. For early stage startups, they've got no assets, they're not cutting invoices, so it just doesn't work. And I'll give you a really horrible example from my experience on why I am anti-debt personally. Rock Technologies, we got to, I think we were at 20 million of revenue, and the supermarket customer, again, a second example I'm using them in, they said, oh yeah, we're not going to pay you in December, we'll pay you in February because we've got our year end coming up and we want to keep cash in the bank. I'm like, that's a lovely breach of contract, brilliant. And we had another customer who did the same. Now, thankfully, they both warned us. But we faced because we were in such an intense growth period, it was just like we were always strapped for cash because the growth was just ridiculous. And we were at EBIT heavy business. We were at 12, 13% EBIT, which is pretty good for an IT company. However, we had a 50 grand shortfall in December. So we approached our bank and said, right, we need 50 grand for a month just to get over this hump. And then
they were rubbing their hands.
No, they would do it, but they're like, we want personal guarantees from all of the directors.
Absolutely. Yeah.
And I'm like,
and it's short term, it's bridging, so they're going to be, charging a premium. Right?
Yeah, and I didn't mind the premium. I can, hold my nose on the premium.
But the PGs are a bit distasteful, aren't they?
Yeah, I'm risking my home. I'm risking bankruptcy.
Yeah,
we
for
all
50 grand,
for 50 grand, and we all kind of got 50 grand out of our pocket. And went,
they are.
Well, don't bother. And I mean, if I were a startup founder, the failure statistics on startups are ridiculous. Well, it's 7 out of 10 within the first 5 years or something.
I think it's more than that.
And therefore, if you were a startup founder, would you risk PGs putting money into the? Absolutely not. You're going to do equity finance and give angel investors the risk.
Well, you say that. I mean, the British Business Bank have this startup loan scheme.
Yep.
Where for you can borrow, yes, it's personally secured, personal guaranteed, but you can borrow 25k per director in your company, right? So, and it's non-dilutive and it's 6% per annum.
Yeah.
So, I know a number of founders that have gone that route, but they've really had to back themselves. They've only done it once they've got their companies to a point where they can trust they can repay the debt.
I think that's it, isn't it? Yeah.
Yeah, but I mean the facility's there. It's just once you take the king shilling.
I just can't bring the PGs just don't make sense for me.
They don't. Although there are indemnities, you can lay off 80% of it. Assuming you're not negligent, of course. But for something like 4 or 5% of the quantum, you can be laying off 80% of the PG. So oftentimes these PG-backed facilities are being sold alongside an indemnity kind of policy, which that's just perpetuating the practice, right? And of course, the FCA have completely opted out and said, "Oh no, well this might stray into personal lending, but it's not really our bag. This is commercial. This is a commercial arrangement.
Technically, it's a loan to a company, isn't it?
And it's unregulated.
Yeah.
Yeah. So it is, and until action is taken legislatively, that's just going to continue, isn't it? So, But so debt best to be avoided if you can't afford to repay it. I think that's a very strong message and one we should all stand by. So just looking back on your entrepreneurial career, was there a particular decision or pivot or moment that stands out as having a profound impact on your success trajectory? Is there one thing that you think, so glad I did this, beyond the SEIS? Can't keep banging that drum.
Yeah, damn it. I mean, the most obvious thing, and I had no choice over this, if 2E2 hadn't collapsed, I would still be working for 2E2. I had golden handcuffs apparently, but if you do the maths, actually, given the dilution and the cap table and the, they'd have been worth £50,000, but
This is options.
yeah, or options within 2E2, which obviously went to dust when the business disappeared. But it's amazing that it was a lesson in life there. The emotional attachment that even a relatively small percentage of ownership in a business creates between employees and employees in the business. So the reality is I'd probably never have. I was relatively well paid. I was given lots of opportunities in that business. I don't regret a second being there, but I also don't regret it collapsing, because that gave me the kick up the arse I needed in order to roll up my sleeves. And I think the timing was perfect. If I'd have tried to be an entrepreneur in my 20s, that would have ended very, very badly. So I think
needed some life under your belt.
Yeah,
first.
Need some experience. I'd delivered some big projects. I'd ran big teams. I'd learned lots of lessons along the way. So the timing was good.
So life needed to give you some lemons in order for you to go and make some lemonade.
Yeah.
Nice. Love that. So looking forward, what are the sort of personal and professional milestones that you're focusing on maybe over the next 3 to 5 years? Congratulations, you've just got engaged. So
thank you.
In case you weren't aware.
I did get a text about it earlier.
Oh, excellent. Good, yes.
My personal aspiration is to, I think I'm like you in this respect, and I think I'm going to do this really badly, but I'm going to stop hoovering up opportunities and things to do with my time. I'm going to focus on the 2 businesses that I love dearly. So I'm going to focus on those and focus more of my time on my family. So I'm trying not to get distracted by anything else at all. And that's hard. I've got a mind. I've got lots of ideas. I've got lots of ideas that I think I could run with, and lots of people bring me lots of ideas as well by virtue of what I do. But I'm being very, very focused on not hoovering up anything else. I want to really continue, and I hope this happens, to thoroughly enjoy every step of my journey in both of my endeavours, and I enjoy them in different ways. There, in some ways, Forge Technologies feels like a well-trodden path, but I'm really enjoying that. And I'm working with the new management team, which is amazing. And Founder Catalyst, I'm enjoying. We've just released EMI and unapproved option schemes, and I've got a bunch of other products that we are building over time. So I'm really loving that journey. So I just want to enjoy what I'm doing.
Carry on, double down, and broaden the offer at Founder Catalyst, and keep on ringing the cash register.
Yeah, exactly.
One hopes. Good man. Well, listen, it's been an absolutely inspiring chat, and thank you so much for sharing your journey, your experience, your insights with us. Your brain works so fast, and it's always an absolute pleasure hearing from you and your perspective. So thanks for joining us today. I hope the listeners and viewers have appreciated it as much as I have. How do people get in contact with you if they want to know the SEIS trick, or they are out starting a brand new venture that qualifies as an innovation, and they want to make use of your SaaS services?
Amazing. Well, maybe in the show notes we can put we've actually got a landing page for Founder SEIS, which talks through some of the nuances. The only social media I'm on is LinkedIn, the only one that matters. I think snappily Sam Simpson 1, which is useful.
What?
But I don't know. But Sam Simpson on LinkedIn. Always love an IM from. It'd be great to hear from some of your listeners.
Oh, careful what you wish for. There goes your inbox full of IMs and PPMs, and to accompany all of the pitch decks that you have on a daily basis, of course.
I'm sure they will all be AI generated as well, which is
which is a conversation for another day. How do we focus on the signal through the noise? But there we are. Great. Well, thank you again so much, Sam, for joining us today. Listeners, viewers, tune in next time for another interview with a successful entrepreneur. And until then, keep on crunching. Bye for now.